Okay. And we started, gold was down at 250. We started gold's first advance here, which is taking gold to around $1,100. We had crude oil. It's not that long ago, you guys, that we remember crude was at $10 a barrel.
Yep.
Now it's what is it, 77,
77.
I wrote an article talking about $30 a barrel one
Okay.
time, and everybody thought I was nuts.
So if that's the case, and if we buy the argument, and I do, I think we're in an economic environment of digestion. And let me put it this way: we've had the roll up after World War II in the 50s and 60s, right? The go-go growth. Remember the go-go stocks and all that kind of stuff. Low interest rates in the 50s. I mean, 2% mortgages your mom and dad got when they were in their 50s.
Well, I
after the
remember
war.
in the TD Bank on Academy Road in Niagara, there was a sign in the window, very discreet sign because banks didn't advertise then, and it said interest mortgages 1.5%.
Yeah.
I remember that. Yeah.
So we had those. That was an era of the 50s and the 60s. Then we had this build-up economically, globally, to the point in 1968, 69. Then we had assets were overvalued. Boom, down they come down. It takes 20 years to digest that overbuild, whether it was stocks.
Well, is it a generation of kids, another generation that forgets about what happened? Is that what it is?
There's nothing new, David. It's a recycling of the same old, same old.
Yeah.
It's just every new generation has to learn
Every young generation
has to learn everything all over again, right?
Yeah, Mitchell is my son over here, and
Yeah.
you've got some kids. You had your two here. Sometimes, remember when you were a kid and you didn't think your father knew anything?
Yeah.
And then afterwards, when you hit about 30, you figured, gee, that guy was smart.
Yeah.
Is it something like that?
Kind of like that.
That kind of thing?
It's kind of like that.
Okay.
It's just human nature. This has nothing to do with economics. It's all to do with human psychology.
Yeah.
So in
social-
effect, you're talking about the boom, the baby boom, and following that cycle, we've got the boom, we've got the echo, now we've got the second echo.
Yeah, it
Generation
rotates
X,
back and
Y,
forth.
Z,
I mean,
and
I guess to boil it down to simplicity sake is that we get 20 years of disinflation, and this is easily characterized in the recent phenomena from a 21% interest rate down to, well, let's call it a zero interest rate today.
It was at one
The
time.
administered rate, right? So the world changed in 2001. We now have an inflationary bias. We've had the first run at risk reinflation. You haven't seen it in a variety of things, but you've seen it in commodities. And this has been, in the early days, not so much, for example, people talk about inflation like wage pressures and so forth. This has been a reflation because of what I call competitive currency devaluation.
right.
Okay, so it's the U.S. wanting to devalue the dollar to pay their debts back in cheaper dollars. Everybody wants, it's a race amongst countries to devalue the currency.
But you have China in there that is
Well,
growing
let's-
a middle class.
Right.
You've got the
Sure.
technology
And you've-
revolution that has moved away from the hard goods and
So
toward
added
the
on top
yeah.
of-
I mean, these are all things
these
that
are
you have to
competitive
take into consideration.
So,
But yes, there's
the
an
que-
underlying cycle
and-
there.
Sure. So to answer your question, where are we? Is that we're probably mid-cycle in this reinflationary cycle, and which means that we ain't seen nothing yet.
Yeah.
People. I'm not a gold bug per se, but if you've got to go a long way to get to the equivalent inflation adjusted value for gold of $841 or $40 in 1981 dollars.
Yep.
Like you're maybe, $2,000 or $3,000 gold is not an obscene number, and that's in terms of where we might go. Typically in these cycles, just like if you look back at the early 70s and the late 70s, we have oil run to $80 a barrel or whatever. The back half of the cycle, the last 10 years of the cycle, is where the big fireworks happen.
Yeah.
We're just getting warmed up in terms of a lot of
So
this
you
stuff.
figure we got another 10 years or so to go.
I think for most of I'm 56 years here. I think for the rest of my investing career, that I will be compiling portfolios for client with inflationary,
Hedges.
well, hedges is one word, but investments to gain from an inflationary environment.
Right.
And I think, I had a discussion with a client here recently who was an income type client, protection client. And I said, Martha, we need some gold, and we need to put some gold investments. We need some oil and gas. I can't have you in Government of Canada bonds paying at 2%.
Right.
We need something here but Dan, inflation's so, that's not a big deal and so forth. But I said, my point is, if you're going to make any money over the next 10 years, you aren't going to do it in the bond market. Let me give you an example. We're at what I call nosebleed levels in terms of bond pricing and so forth at 1 or 2% interest rates, right? These are generational lows in rates.
Yep.
So as for example, funding requirements from governments are required. Let's face it. I mean, the American government's going to have to come in for a couple of $1 trillion. Where are they going to get the money? So they're going to have to sell bonds to the public. The Chinese are reducing their U.S. dollar bond purchases.
Right.
This is going to put pressure on interest rates to go up.
Yep.
Because all governments on the road, whether it's Great Britain, whether it's the United States, are going to be coming to the market to raise money.
Greece.
And Greece,
Yeah.
Spain, Portugal. So there's going to be, arguably, for example, U.S. Treasuries, 10-year Treasuries are trading around 4% right now. You could make a pretty strong case that 2 years out, 3 years out, we'll see U.S. 10s at 7%.
But they're
Think
just
so,
they're
okay?
they're basically just printing money. They're printing money into that market.
Well, that's the issue. If you look at the way a government runs itself, there's 3 ways a government can raise money, right? They can tax it, which they're going to bump the taxes. That's a pittance compared to what they need. They can borrow it, right?
Which is what they've been doing.
Which they've been doing, or they can print it.
That's right.
And that's a situation where many governments, other than say Brazil and China and some of the cash-rich governments, are faced with. I mean,
But the U.S. or the free world in general did some pseudo printing over the last 20 years in terms of the expansion of the credit market, because
haven't, but
that's effectively the same type of thing where the money
Well,
supply
let's-
increased,
yeah.
not based on
But the
hard
banks did
currency.
that.
No,
All the
let's just-
banks,
Let's just
the
stop right
banks
there
did
for a
it.
minute.
Yeah.
Let me just explain that because it bears explaining. People have this misconception of what causes inflation, and the problem has been is that governments have been printing money, so the money supply has been increasing, but the velocity of money, the recycling of money has not. Banks
Yeah.
have not been lending. So when the government prints money, it goes through its lent and then deposited and lent.
Yep.
It's the velocity of money. So you need the amount times the velocity
Right.
to superheat the monetary system. And we got the government printing the money, but it's not being recirculated. It's all for example, this last go around, people are astounded that the stock market came back so fast from March of last year on arguably questionable economics.
Yep.
Right.
So why did that happen? Why it happened is because this humongous amount of money had to go somewhere. And so it's lifted it up to, let's call it fair valuation levels.
And
At
nobody
this-
wanted to put it into houses this last while.
Well,
Yeah.
we're now starting to maybe a little bit. So anyways, we are up, and I am of the belief, if you ask the question, so I'm going to give you my best shot in terms of an answer, because I think it has big bearings on making money over the next 10 years, particularly for anybody really. I think it's going to be a rising interest rate world. So arguably you're going to see rise, it's going to be a bump and grind affair, but we're going to have a sloping up interest rate structure, which means that in the bond business and fixed income business, most of these pieces will come under pressure. And for example, when I started as a broker in the 70s, you couldn't spell bond. And the reason you couldn't spell bond because we never bought one. And the reason why is interest rates always went up and bonds always went down.
Yeah.
Then if you had the wisdom in 1981 when rates were 21%, and I remember this, there was the government of Canada's 4.5% bonds of, was it 1995? I forget the actual maturity rate. The government of Canada yield in those bonds were priced at 55 cents on the dollar, and the yield to maturity was 18.5%
Yep.
for 20-year bond.
Yep.
It locked her in, and
You bought those $55 bonds, you would have done well.
it was a wonderful thing. We are at the opposite reverse of that now. We are at, bonds, majority of bonds, for example, that have been issued, traded at premium.
Yeah.
They traded 120 cents in the dollar, 130 cents in the dollar. So I mean, when they give you back your money at the maturity date, they only gave you back 100 cents on the dollar.
Yeah.
So you've got
And you
some
paid
tax planning
120.
questions now, and people have a hard time understanding this. In that, my bond's trading at $120 and so forth, and they say, well, but I'm getting 7% on the coupon, and I said, yeah, but the bond's worth $125. Your yield to maturity is only 1.5%.
Yeah.
Yeah.
So you have to realize those gains now and find
Like,
something else
yeah.
to do with the money. I think